So to start with, as far as the macro is concerned, look, and Dr. Pant, correct me if I'm wrong, but I think we are going to get a positive deflator after a number of quarters, and which would of course mean that the nominal, which shrunk last year, is actually going to expand. And two things. One is, what is the sustainability of this deflator? Where do you see this while you've projected for, I think, the next year? Where do you see that going for the next couple of years?
Average WPI deflation in the second quarter of this fiscal was 4.5%. That had resulted in entire GDP nominal growing at a rate lower than the real. After that, the deflation is still there, but that is subsiding. Now, Jan was again a month where we were initially expecting it to turn positive. But again, the second round of collapse of global crude prices, leading to Indian crude oil basket at $28.35 a barrel, lowest since November 2003 in dollar terms and May 2005 in rupee term. So we are expecting now this to be in the positive territory in the month of February. Going forward, next year, our forecast suggests the WPI will be growing at around 2.5%. That will lead to the nominal GDP growth coming somewhere closer to what we had witnessed in FY15, closer to 11%. So we believe the inflation will inch up, it will remain benign, and what the Indian economy, not only the Indian economy, but the global economy needs, a phase of benign inflation, not the deflation. Because what deflation is doing, it is affecting the balance sheet of both corporates as well as of the government.
As the nominal growth picks up, thanks to the headwinds, thanks to the tailwinds from the deflator, does that do some good to the corporate balance sheets?
While the WPI may increase over the next few quarters, my belief is that probably realistically you may not still see the kind of growth in the top line and the bottom line given the overall environment. The other issue was that the pillars to support this growth also don't seem to be too strong at this moment, especially at least for the next 12 to 18 months. So whether it's looking at exports, investment, consumption to a certain extent, and maybe even the government's role in the whole scheme of things. So yes, maybe over a period of time you may see a lot of benefits coming from inflation picking up, all these maybe turning around in a more favorable way. But it's clearly for the next 12 to 18 months, I think probably I do see challenges in the nominal growth actually moving into double digit just because probably inflation moves up on account of that.
Rakesh mentioned that currency is obviously one of the vulnerabilities given the unhedged exposures. What's our house view on the currency?
We believe there will be temporary upheaval in the currency market. It may fluctuate. There will be volatility, day-to-day volatility, depending upon what happens in China. But we still believe, our forecast suggests, that the average value of Indian currency in the fiscal year 17 is likely to depreciate around 3.6% from the average for FY16. So our estimates suggest it will average out at around 67 rupee 52 paisa a dollar between for 1st April 2016 to 31st March 2017.
We've talked briefly about investments and the government's limited capacity to expand. But at this point, where are the investments happening?
First is the solar power. This year we have added 2 gigawatts, which is 1 gigawatt entails an investment of $1 billion. So only $2 billion into, but next year at least $10 billion of investment will come into solar power alone. Second area for investment would be the refinery space. The product demand for petrol as well as diesel is increasing, and probably it will also increase for LPG in the time to come. So in order to meet that demand, the PSU refiners are likely to add further capacities. Already the 3 larger OMCs are talking of a 60 million ton refinery. The third area will be the CGD space, which is the city gas. As gas prices remain benign and as more and more cities get CGD network, so we believe that there could be further investment in this as well. Also, regulation will also drive further investment into the CNG space.
Let's shift a bit. I mean, we've been talking capital intensive all along. Let's shift a bit to the consumption side. And let's get a hang of what's happening, because there the news seems to be somewhat more positive. Let's start with autos. What's our sense? I mean, we remain stable there. There seems to be some early signs, and probably driven by the rates, interest rates may have something to do with that. What are we seeing in that space, both on the passenger and on the commercial side?
Major growth is coming from the commercial vehicles, medium and heavy commercial vehicle segment, which has grown at more than 25% over the last few quarters, and it is probably likely to continue out, those elevated rates. Perhaps not at about 20, but definitely up to about 15%. Most likely, in going forward, while the growth of the heavy commercial vehicles may slow down a bit, for the last mile delivery and those kind of LCV volumes might pick up, but not by much. Again, driven by both the fall in prices as well as softer interest rates, passenger vehicle segment is also seeing some increase in traction. Not in the double digits, but it is likely to be somewhat better than earlier years. Two-wheelers, of course, have not seen much of a growth. It's likely to be flat. So there is growth, and there is also an increase in profitability, which is what we like.
A couple of consumption sectors where we remain cautious, realistic, of course. We've been read on that for, I don't know, this is our third year running. And the other was pharma, where you've changed your outlook. You were bullish last year, and this year a bit more circumspect. Can you, Prasanna, run us through these sectors?
Area sold by listed builders, who give out data, if we track that, that has been falling continuously for the last 2 years. This is also accompanied by an increase in price. I can't see how the prices will come down, and therefore the consumption will also likely to be low, and therefore we are negative on the sector. But now coming to an entirely different sector again, yes, pharmaceuticals, we have changed the outlook from positive to stable. Main reason for this was the fall in export growth. Now, apart from this, there is also the a fall in profitability because of the expansion of in the domestic market, because of the expansion of the drugs under the DPCO. So these are the reasons why we are now back to stable from positive. Why stable? Now, it's a sector which is generating cash flows even after capex. So that is one strong thing, and most of the the interest coverage is very high in this sector. The leverage is low, and our ratings are also, most of the ratings are in the A or above category.
Thanks, Prasanna. And finally, now to financial services and the biggest elephant in the room. Look, we can keep debating as to what's the future of the PSU banks, but is there a sense that we are developing? Your sense of what sort of amount that the government needs to budget?
Pure growth capital at even 13.5% growth, which is modest by the nominal GDP standards. The requirement for government would be about 1.4 trillion, almost double the amount promised under Indradhanush. You add another 1.5 trillion INR from the AT1 market, which hasn't picked up really. And if we are talking about the additional 1 trillion haircut, which could come from the large stress corporates, it's already started happening, I think, this quarter results. So we are talking about something like 35 to 40 bips of GDP for next 3 years. So that's the kind of, I think, number one needs to look at.
Abhishek, finally on the NBFCs. While the road looks great for NBFCs the next 3-4 years, is it possible that as those the government tries and improves those grassroots institutions, suddenly NBFCs would have a competition from people who are perhaps more familiar with the ground realities? Is that a possibility you see?
Yes, definitely there could be a challenge in some spaces. Even particularly in mortgage, I think that's an area where even public sector banks are trying to grow more aggressively. So there could be pockets where this competition could come up. But the point we are making is, I think if we are looking at kind of growth scenario for next 3 to 4 years, given that nominal GDP will at least get into double digits next year, the expectation is clearly there will be huge room for all of them to grow.